Assuming we've done sections 1 through 5 correctly, in the end we have some sort of net worth and some assets that we need to manage. Unlike other sections, I'll mostly be focusing on just a few finer points and leaving a lot more to, say, the articles and links I'm providing below. So let's review assets very quickly. What are assets? Assets are things that you have that should be valued at what they are worth, not what they are paid, not what you paid for them. Remember? Hopefully. Awesome. You can break down assets, remember, into physical assets and financial assets. Things, say, in the real world is like physical goods, say gold or a car or a house, or a financial asset like a bond or a stock. Let's walk through a few quick examples to nail this concept down with financial and physical assets. Some examples of financial assets could include, say, cash, a checking account, stocks, bonds, savings, money market, mutual fund. We'll talk about ETFs as well. Really complex financial instruments are financial assets. But as far as the pros and cons of financial assets, I mean, financial assets tend to be very hard to steal in the modern age, and it's usually really easy to know what they are worth. On top of that, they don't take much maintenance. So those are the definite pros. There are also some cons that run with them, and it's kind of the opposite of the benefits of physical assets. So we'll talk about them. Now, examples of physical assets are like a car, house, jewelry, maybe furniture-ish. They probably depreciate very quickly. Maybe you have a prized hobby collection of whatever you collect, your action figures and baseball cards, I don't know. So there are also lawnmowers, electronics, boats, ATVs. The nature of physical assets, on the pro side, sometimes you can actually use them and they can actually provide enjoyment. And there are other benefits to them. Say if financial assets tend to correlate in value together sharply, so physical assets may be a way to diversify away and retain value. But one of the downsides of physical assets is that they tend to depreciate in value and do not preserve wealth very well. And now you can fight against that depreciation. Like you can maintain them, there's security, there's different things, but then at that point, you're going to be losing some in time. So as a general rule, the more things that you physically own, the more money you lose in depreciation. And that's an argument where minimalists, kind of the minimalist philosophy, it has its strongest argument there because it's like, well, if I want to be financially independent, then I don't want to own lots and lots of physical assets. And the pros is like we listed previously, but as far as the cons, 1 is the depreciation, 2 is potentially the time that you have to invest in preventing that depreciation and keeping track of those. So financial versus physical assets, pros and cons for each. Besides just the physical and financial distinction, how are asset classes generally broken down? You can read more about that below. Quick review here. These asset classes, these are different types of assets, and this distinction is important because they behave in different ways. So you could take something like even just corporate stock. You invest in a company. Well, there's small, medium, large companies. There's companies that are domestic to the country where you are. There's foreign developed nations. There's foreign emerging nations. Lots of different types of corporate stock to invest in. There are different types of bonds. There are municipalities. There are companies. There are countries. There are commodities and resources like everything from gold and oil to potentially something more exotic like cryptocurrency. There are derivatives, which get a bit more complicated, but also real estate, collectibles. Like each of these different types of assets have different expected returns in different scenarios for the economy and going forward. So a stock is an ownership. It's a share of the ownership in a company, which is why they call them stock shares. You get to share in the ownership of that company. Now, what is a stock share worth? Well, it goes back to our original equation from section 2, assets minus liabilities equals equity. And so first, let's pin down the assets. Remember, an asset is what you can sell it for. But what are you selling? Well, it's kind of the company itself. And if that's difficult to grasp, think of like a fast food store. So let's say there is a McDonald's, and you would like, how much would you buy this McDonald's for? Or how much would anyone buy this for? Well, what are they buying? It's not just, say, the machinery inside of it. It's not just, say, the building. It's this income and these expected customers that are going to be coming in the future. And so how much it's worth, it truly just means how much is this worth? How much would someone pay for it? And that is this difference between these two concepts of book value versus market value. So book value is what you put in the books for what you paid for something versus the market value. The market value is what it's currently worth to other people. And so for us, we value things according to the market value. So we are going to crash course really quickly on what is a stock and then walk through some examples to solidify that knowledge for you. So first of all, there's a term called enterprise value. It's the value of the entire company. So that is the value of all of its stock, of all the equity. It's also the value of all of its debt. So you combine the debt and the stock together, and that is the enterprise value, the whole company. The market cap is a term for just the company's stock, just the equity portion. So you have debt and market cap, and that makes up enterprise value. So this is an insight as far as why are stocks so volatile, because it's kind of uncertain how much a company is worth. How much, going back to our McDonald's franchise example, how much is someone willing to pay for that McDonald's, franchise location? Well, let's say it's next to a interstate exit, and that interstate exit changes 1 mile down the road, and they close that interstate exit. Maybe it's going to be worth less than it was previously. And so there's this question of value of how much it's worth, because it depends on how much people are willing to pay for it. And that's going to fluctuate every single day. So you can realize, you can lock in your gains from stocks either through an increase in how much it's worth, the market cap. So that's like the stock price goes up and there's an equal number of shares, or by the company paying dividends to the shareholders. The third method is that the company can buy back shares so that there's a fewer number of stock out there for every portion of the company. So those are the three ways that you can realize those gains. So a dividend, so what is a dividend? A dividend is money paid to the shareholders. Usually it's like every quarter or every year, and they say everyone who owns a share gets $2 or something like that. So some companies prefer stock buybacks. In effect, in finance, they essentially operate in the same way. Let's walk through an example with Starbucks. So Starbucks, when I pulled this, I pulled it for year-end time, and the price of the stock was $64.40. The total value of the company is that market cap. The total market cap is $80 billion. And as you can see, as every day, the stock price is changing, and so the market cap is going to change. Another thing you could also do is calculate the number of stock outstanding. Well, how could you do this? Well, you could take the $80 billion and you could divide by $64.40, the stock price, and we end up with about 1.24 billion shares outstanding. So there are 1.24 billion shares out there, and each one is worth $64.40. So if you multiply the two together, you have a market cap of $80 billion. You'll also notice in the second circle is that there are these dividends, and the dividend, this periodic payment that's being made, is about $1.44 that is received throughout the year, and that is about 2.28% of the stock. So if you do $1.44 divided by $64.40, you end up with about 2.28%. So you're being paid this dividend that you're receiving, and the value of the stock is bouncing around as well. So again, if you understand the concept of market cap, number of shares, the stock price and how those three relate, and also can understand a dividend and this yield percentage, I think you've pretty much got it down. Now, the basic stock strategies that exist. First is a growth strategies, where you invest in companies with very little earnings but lots of potential. The second is value, where there are lots of earnings but perhaps limited growth potential. The third is domestic, so you could say domestic growth or domestic value, so companies inside your own country. And finally, international. With international, you generally also have the currency fluctuation factor. So you might be investing in a company in France, therefore your earnings will be denominated in euros. Now, what is a bond? A bond it's debt. So how is a bond different from a stock? Well, stock is like equity, and bond is like debt. And a bond is like a share of that debt, just like how a stock is a share of the equity. So typically a bond pays $1,000 at the maturity date. We're going to walk through a couple terms. So the par value, generally $1,000, that's what's paid at the maturity date. The coupon payment pays you a certain amount every quarter or 6 months or every year. So a coupon payment of, say, $50 with a par value of $1,000 and a maturity date of December 31st of whatever year. The yield to maturity is a calculation which basically takes this par value and the coupon payment and the dates and tries to change all of this, transition it into just one simple interest rate. So the yield to maturity, think of it as your interest rate. Finally, the last term is a zero coupon bond. So that's a bond with no coupon, no payments are made, you just receive a par value at the end. Now, a tricky thing with bonds is understanding the relationship between interest rates and the prices of bonds. So when the interest rate falls, the price of a bond goes up. And that's something to think about for a moment. So imagine a zero coupon bond, and before there's a bond for $910, and it's going to mature in a year. And so the return on this bond, for example, is around 10%. But let's say that the price of this bond, or if interest rates fall, the price of the bond would go up to, say, $950 or closer to 5%. So like you had a 10% return at $900, around $900, and our 5% return when it went up to $950. The way to think of it is that you are buying the right to receive $1,000 in the future. As interest rates fall, the price of that goes up because you're receiving less. A little tricky at first. So if you own a bond, then you don't want the price to fall. You don't want interest rates to go up. But if you're looking to buy a bond, you want the price to fall or have interest rates go up. Unless you are willing to really put in the time, you should avoid buying bonds directly and just kind of stick with funds. People have success constructing, say, bond ladders and such, but unless you have quite a bit of money involved and are willing to put in the time, sometimes that is probably not the best use or approach for your time. Now, the value, how much does a bond cost, or what the yield to maturity is, that's going to depend on the value you will receive at maturity, the coupon payment they're paying along the way. So there's this difference in time, the coupon payment, and there's this risk associated with not being paid, either being only paid in part or not at all. So like bankruptcy. So if the company goes bankrupt and can only pay 50% of the value of the bond. Now, when we move into or out of a zero interest rate environment, as we move to zero interest rate environment, the price of bonds will go up significantly. And when we move out of zero interest rate environments, the price of bonds will fall. So back to not getting paid. If you hold a bond, you don't get paid when the company is going bankrupt, essentially. And bonds, they have these ratings. There's these agencies that use ratings to help you evaluate that risk. And the general rule of thumb to remember is that, of course, A is better than B is better than C, and C is better than D. The second rule is that more letters are better than fewer letters. And third, plus is better than minus. And so you want AAA would be, say, the highest, and then you go to AA plus, which is slightly worse, and then AA. So it's A's, so it's the letter, the number of letters, and then plus or minus. And this is an important point to introduce, which is promised versus expected return. So the yield to maturity gives you a promised return. That's what you're going to receive, assuming all goes well. But some small percentage of the time, the company will go bankrupt. And so if you price in the expectations of them not paying you, there's going to be an expected return, and that expected return is always going to be less than the promised return. If you promise me a 10% return, but a small percentage of the time, maybe you can't pay it back, on average, maybe I'm expecting a 9% return. We're going to walk through some examples now to make things a bit more palpable. So how do we calculate this total return on an investment that you have? The formula is the income that you receive, for example, a dividend, plus the ending value minus the beginning value of that asset, and you divide all of that by the beginning value. So let's use an example with a bond. Let's say you buy a bond for $950. It pays a $50 coupon payment, and it matures in 1 year with a par value of $1,000. So your income is $50. Your ending value is $1,000. Your beginning value is $950. So 50 plus 50, that's 100. 100 divided by 950. Well, what is that return? That's about 10.5%. Let's do another one. So let's say you buy a bond for $900. This is a zero coupon bond. It pays a $0 coupon, and it matures in 1 year at $1,000. So what is the return? The income is 0. Ending value is 1,000. Beginning value is 900. 1,000 minus 900 is $100. Divide that by the beginning value of $900, and we end up with about 11%. In the readings, there are some explanations about financial risks and the different examples of economic, company, asset class, industry, market, etc. That's a really good overview of the topic, and I highly recommend reading that. One way of viewing risk is to think on these terms of return on capital, which is your interest, versus the return of capital, of getting your principal back on an investment. Basically, expected return, as we've discussed previously, this is what you expect to receive on average, whereas a promise return is what someone promises to you. So let's go through an example really quick to give you an idea. Let's say 99% of the time you get a 10% return. And 1% of the time, the company loses your money and you get nothing back. You get a negative 100% return. So what is your expected return? Well, 99% of the time, so 0.99 times 10% plus 1% times negative 100% return. You add all of that together and you end up with 8.9%. So that's how you would translate promised return with probabilities into an expected return. Now consider this question: what is more risky, stocks or bonds? Now hopefully this will make some of our previous discussion make more sense. Imagine there's a company that has an enterprise value of $10 million. They have $7 million in bonds, and they have a market cap worth $3 million. That's held by the stockholders, those who hold the equity. Now let's imagine that the value of this company declines by $2 million. The enterprise value declines by $2 million. So what happens? Well, the debt value basically stays the same, and the market cap shrinks. And so in the end, we end up with a company that's worth $8 million in its enterprise value. The market cap is $1 million, and the debt value is $7 million. So the stockholders are the first one to eat the losses, to absorb the losses. They went from $3 million to $1 million, so the stock price, in effect, fell by 2/3, by like 67%. That's huge. Now with bonds, they're not going to adjust in value. When the value of the company goes up, bonds just stay the same. There are some complicated financial instruments and complicated circumstances that can adjust this, but outside of bankruptcy, the value of bonds is basically just the value of the bond. However, what happens when the value of the company falls by more than the market cap? Then you lose the market cap completely, and then the value falls down into the debt value of the company. I mean, this is bankruptcy, essentially. The company then has to be liquidated, sold off in pieces, or maybe the bondholders take over the company. They try to run it and try and salvage what's left of it. And so the stockholders end up with zero, and the bondholders end up with probably less than what they loaned the company. And that's when a bond is not able to be repaid as planned. This is called the capital asset pricing model. I find it very useful even in the context of personal finance. It's usually used in other contexts, but in terms of personal finance, imagine that on the x-axis you have your risk, and on the y-axis you have your return. So this is a line that is slanting upward, and as risk increases, assuming diversification and some other assumptions, your market return is going to increase. Your expected market return increases. And where you have zero risk, where the x-axis equals 0, so the y-intercept, that is the risk-free rate return. Or if you don't put any risk on the line for your money, you know you're going to get it back, that is what the risk-free rate of return is. Let's recap those points really quickly. So first, what is the relationship between risk and return? More risk means more return. So CAPM it's relatively straightforward. Your return is on the y-axis, your risk is on the x-axis. And as we increase risk, we increase return. And the y-intercept is known as the risk-free rate, or no-risk rate. This is the time value of money, and there's no risk involved. The important assumption to all of this, CAPM, capital asset pricing model, assumes diversification. It assumes you are diversifying across a bunch of different assets. Now, there are quite a few lessons from CAPM. First, diversification is super important. We'll be talking about that next time. But second, how the shape of the line, like which way it's going and where the y-intercept is something that informs you on how to make decisions. So if the line is relatively flat, what does this mean? Well, it means as you increase risk, you only get a little bit more return out of it. Oh, that's important to know. If you want to get a lot more return, you have to take on lots more risk. If there's zero interest rate policy, what happens to the y-intercept? Well, the line shifts downward, and the y-intercept gets closer to 0. In real terms, it could even become negative. And one thing to know is that risk in these, this financial world, it's sometimes measured in the statistical term standard deviations, and other times you'll hear the word beta, where a beta of 1.0 is kind of like the stock market, and less than 1.0 would be more conservative, and more than 1.0 would be considered aggressive. And if you've been a little bit confused compared to section 1 versus section 6 in this course, people use the word risk and volatility interchangeably in the investing world. They often will do that, and that's okay. From section 1, we understood a slightly different definition of risk that was a bit more appropriate for personal finance, but this slightly different definition shouldn't scare us too much. One of my favorite use cases that someone else introduced to me with the capital asset pricing model in personal finance was the student loan case. That essentially, so with student loans, they're non-dischargeable in bankruptcy, as we've learned. Imagine that the interest rate on your student loan is, say, 6%. In essence, you could pay $1 to pay down your student loan, and that's a risk-free rate of 6%. Or say you could invest in the market and get perhaps an 8% return on average, but with a lot more risk. Perhaps someone in that scenario looks at that and says, well, it's not worth all of that risk for just that additional 2%. Maybe I'll pay off the student loan. And so when you're using this model, looking at your own debt in terms of the risk-free rate, looking at the market return for a diversified investment, and then comparing, what is the slope of this line looking like in the market currently, can be hugely useful to make these personal finance decisions in terms of, should I pay down my debt or should I invest more?